On May 24th, Vitalik Buterin posted roughly 1,500 words to X that read less like a vision statement and more like a confession. The Ethereum Foundation is shrinking. ETH sales are being cut. His own influence over the board is, in his words, going to continue to wane. And all of this arrived exactly 3 days after a former senior EF researcher published a rival proposal, calling for a $1 billion organization to do the job the Ethereum Foundation apparently no longer can. So today I'm going to walk you through exactly what Vitalik said and why he said it now, dismantle the idea that this is a vision statement rather than damage control, and lay out the structural problems that no amount of cypherpunk language is going to fix for ETH holders. My name is DC and you're watching The Coin Bureau. Now, before we get into Vitalik's actual proposal, you need to understand the pressure cooker he was responding to, because this post did not arrive out of nowhere. ETH is currently trading at $2,060. That is down roughly 20% year on year and approximately 46% below where it traded 2 years ago at $3,823. The ETH to BTC ratio has collapsed to 0.027, a 10-month low. Spot ETH ETFs have just printed 10 consecutive days of net outflows. Cumulative ETH ETF outflows in 2026 alone have crossed $2.4 billion. Harvard Management Company fully liquidated its $86.8 million Ethereum ETF position in Q1, and the leadership picture inside the foundation has been, frankly, a slow-motion crisis. In February, co-executive director Tomasz Stanchuk stepped down less than a year into the role. In April, operations lead Josh Stark resigned. Then in May alone, 5 senior contributors walked out of the door, including Barnabé Monod, Tim Baiko, and Trent van Epps. The on-chain analyst Bantech summed it up in one post: all 3 EF protocol leads gone. Which brings us directly to the post itself, because the timing tells you everything you need to know about the motive. So what did Vitalik actually say? The headline is what he calls the smaller ship framework. In other words, the Ethereum Foundation is going to be smaller. It is going to focus only on what he claims it can uniquely do. And he wrapped that focus in a 5-letter mandate called CROPS, which stands for censorship resistance, capture resistance, openness, privacy, and security. He explicitly said that competing with rival chains on throughput and TPS is, quote, a route to mediocrity. So the Ethereum Foundation is now stepping out of the speed war entirely. On the treasury question, he committed to selling less ETH, framing it as longevity over breadth. He pointed out that EF holds roughly 0.16% of total ETH supply, compared to other blockchain foundations sitting between 10 and 50%. Vitalik disclosed that approximately 90% of his own net worth is held in ETH. He also confirmed the board is expanding and that his personal power inside it will, in his words, and I quote, continue to decrease, which is honestly what I want. And he framed Ethereum's future role as part of an ecosystem of sanctuary technologies optimized for robustness against governmental and regulatory pressure. To put it simply, the Ethereum Foundation is no longer the center. It is, to use his exact phrasing, one node with a defined purpose alongside other nodes. Now look, on its surface, this is the most aggressive philosophical reset the foundation has ever published. Smaller treasury sales, less central control, cypherpunk values reaffirmed, a clear mandate, a humbler CEO. If you read it cold with no context, you would call it leadership. But context is exactly what this post does not survive. Which brings us to the contrarian read. Because every single reform pillar in this announcement maps with surgical precision onto a specific public criticism the foundation has received over the past 18 months. Critics accuse the EF of dumping ETH on its own holders. Vitalik's response: we'll sell less ETH, and by the way, we only hold 0.16%. Critics accuse the EF of behaving like a central authority over a supposedly decentralized network. Vitalik's response: we are one node, not the center. Critics, including Laura Shin, said Vitalik's rhetoric about decentralization never matched the EF's actual behavior. Vitalik's response: the CROPS mandate now formally aligns operations with cypherpunk values. Critics, most notably Dankert Feist, argued the EF is economically misaligned with ETH holders. Vitalik's response: 90% of my net worth is in ETH, and my board power is decreasing. Critics said the EF was chasing a doomed throughput race with Solana. Vitalik's response: chasing TPS is a route to mediocrity. Critics pointed at the brain drain as evidence of internal crisis. Vitalik's response: A smaller, leaner foundation is the plan. Now, you might assume this is just what good leadership looks like: responsive, reflective, willing to evolve. However, that assumption ignores the timing.
Right, if you're looking to trade these latest market moves, whether that's crypto or traditional assets like gold and commodities, then BitGet is definitely worth a look. They've just rolled out their TradFi trading platform, which lets you trade assets like gold and other commodities directly using USDT, so you don't need to jump between platforms. You also get deep liquidity, low slippage, and access to up to 500x leverage. Now, if you sign up using the QR code on screen or the link in the description, you can get up to $50,000 in bonuses. And on top of that, if you complete your first net deposit of $5,000 and place your first trade, you'll unlock a VIP 3 trial. Now that includes up to 38% fee discounts, exclusive VIP perks, and free token airdrops. So scan the QR code, check the link below, and see what BitGet has to offer.
This post landed 3 days after Dankrad Feist, a former senior EF researcher who has since left for a competing chain called Tempo, published a proposal for a separate $1 billion organization explicitly designed to do what the EF allegedly will not, which is advocate for ETH the asset and drive price appreciation. The honest read is this: when every reform you announce can be traced back to a specific complaint someone louder than you made first, you're not leading the conversation, you are answering it. And there is a meaningful difference between a vision and an audit response, even when both produce the same paperwork, right? Which brings us directly to the structural problem nobody at the foundation seems prepared to address. Governance reform fixes governance. It does not fix tokenomics. And the criticisms that have been crushing ETH for the past 2 years are not really about who sits on the EF board. They are about where the money actually goes. So let's talk about that. In March 2024, the Denkin upgrade introduced blob transactions for layer 2 data, and the intent was reasonable. Make L2s cheaper, drive adoption, scale Ethereum without compromising the base layer. But the consequence of that has been brutal. L2 data posting costs collapsed by 80 to 90%. L2 activity became economically decoupled from base layer demand, and the burn mechanism that powered the entire ultrasound money thesis collapsed with it. Daily burn rates fell from over 2,000 ETH in late 2023 to roughly 300 to 400 ETH by early 2025. Today, ETH is structurally inflationary, approximately 45,000 new ETH per month. Yes, you heard that right. The asset that was sold to a generation of holders as ultrasound money is now adding supply every single month, with no clear path to deflation. And even worse, the value being generated on top of Ethereum is not flowing back to ETH holders. It is being captured by the layer 2 operators themselves. Coinbase's Base, Off-Chain Labs Arbitrum, OP Labs Optimism. These are for-profit entities and they have no protocol level obligation to share sequencer revenue with the base layer. Some analysts have estimated that Base and similar layer 2s have redirected significant fee revenue away from Ethereum mainnet and materially dampening base layer value accrual, although the precise market cap impact is debated and no single agreed upon figure exists. Nothing in Vitalik's Crops mandate addresses any of this. Crops is censorship resistance, resistance to capture, openness, privacy, and security. It is not a tokenomics framework. It is not a value capture mechanism. It is not a plan for how ETH, the asset, actually accrues value as the network scales. And here's where the developer picture gets uncomfortable too. According to Electric Capital, Ethereum still has roughly 31,869 active developers as of September 2025. That is the largest pool in crypto, but its share of total blockchain developers has collapsed from 82% in 2020 to just 31% today. Solana, meanwhile, has gone from 6% to 23% over the same period. Full-time developer growth on Solana is up roughly 30% year on year, according to Electric Capital. And Dragonfly Capital pointed out that Ethereum core developers earn a median of about $140,000, which is 50 to 60% below the broader crypto market average of $359,000. So you have a foundation that is shrinking, a treasury that is being deliberately conserved, and core developers being paid less than half of what they could earn elsewhere. That is not a recipe for retaining talent. That is a recipe for accelerating the exact brain drain Vitalik is trying to reframe as healthy decentralization. Now look, before we get into the bull and bear case, I want to give you our own team's read on every catalyst that hits this story as it unfolds, because this situation is going to move fast. Glamsterdam, the EF board expansion, Dankrad's $1 billion proposal, ETF flows, every twist is going to matter. That is exactly what we cover in the Coin Bureau Telegram channel. Breaking news, deep dive alpha, market updates pinged directly to your device so you don't miss a thing. Join us using the link in the description or the QR code on the screen right now. It really is worth it. Now, for the structural turn, which is the part most people completely missed. The honest framing is that Vitalik is not wrong. The foundation did need reform. The dumping accusations were real. The leadership instability was real. The drift away from cypherpunk values was real. And in a world where regulators are tightening their grip on crypto globally, a credibly neutral settlement layer optimized for censorship resistance is genuinely valuable. That is the bull case, and it is not a bad one. If the Clarity Act passes the full Senate and institutional DeFi unlocks at scale, Ethereum is the obvious settlement venue. It already controls roughly 60% of the $34 billion real-world asset market. Ethereum hosts more than 50% of all stablecoin capitalization. It already has the only stage 1 decentralized layer 2 in Arbitrum, and it has a yield-bearing ETF product in BlackRock's ETHB that Bitcoin structurally cannot match. If tokenization scales to Standard Chartered's projected $4 trillion by 2028, even a declining market share for Ethereum represents an enormous absolute increase in settlement demand. Standard Chartered's Geoff Kendrick still has a $7,500 price target on ETH by year-end 2026. And of course, Tom Lee's Bitmine is actively accumulating, targeting 5% of circulating supply. These are not unserious voices. But here's the asymmetry. Cypherpunk credibility does not show up on a price chart. The market does not price values, it prices expectations. And the bear case is that Ethereum is being asked to win on a 5 to 10 year thesis while Solana is winning the next 12 months on pure execution. Solana processed roughly 25.3 billion transactions in Q1 of this year. In contrast, Ethereum processed approximately 202 million. That is a 125x gap. Solana's weekly DEX volume of 11.49 billion already exceeds Ethereum's at $7.62 billion. And not just that, Solana has recently also overtaken Ethereum on real-world asset lending deposits. 1.23 billion versus 1.13 billion dollars. And Hyperliquid, an asset most people had not heard of 18 months ago, has captured 43% of weekly crypto fee market share in perpetual futures. That is the highest margin on-chain market on Earth. Hyperliquid's FTV briefly even surpassed Solana's. Arthur Hayes is now openly predicting ETH falls out of the top 3 by 2030. His holy trinity of positions is Near, Hyperliquid, and Zcash. ETH is not on that list. Polymarket odds of ETH losing its number 2 market cap position by the end of 2026 have moved from 17% in January to 59% as of this month. And perhaps the most damning signal of all, David Hoffman, co-founder of Bankless and one of Ethereum's loudest evangelists for years, liquidated his remaining ETH holdings. When your own broadcaster starts selling, that is a structurally bearish data point that no governance reform can ever cover up. The honest truth is that the realistic scenario sits somewhere between the bull and the bear case, which would look like this. Ethereum stabilizes as the institutional settlement layer. Solana wins retail, payments, and high-frequency execution. Hyperliquid and specialized app chains eat individual verticals one at a time. And ETH, the asset, trades less like ultrasound money and more like industrial infrastructure. The reforms buy Ethereum credibility. They do not buy growth. Which brings us what this actually means for you as a holder. First, watch the Glamsterdam upgrade, which has been delayed from June to Q3. If it ships and delivers anything close to the 78% gas fee reduction and 10,000 TPS targets, it gives ETH a fighting chance to recapture some of the economic activity currently trapped inside L2s. If it slips again or arrives with bugs, the bear case accelerates. Second, watch the ETH ETF flow data. The 10-day outflow streak needs to break. 3 to 5 consecutive days of net inflows would be the cleanest signal that institutional capital is willing to reaccumulate at these levels. Third, watch what happens to Dankrad Feist's $1 billion proposal. If a serious advocacy organization actually gets funded outside the EF, you have a legitimate counterweight that explicitly exists to make ETH the asset win. If it dies on the vine, the EF's quiet retreat becomes the only game in town. Fourth, watch the EF's actual on-chain treasury behavior over the next 90 days. Vitalik said the foundation will sell less ETH. Arkham Intelligence will tell us very quickly whether that promise survives contact with the EF's operational cash needs. Already in May, the EF unstaked more than 38,000 ETH, including a single 21,270 ETH unstaking event. A statement is not a policy until the on-chain data confirms it. And lastly, watch the developer migration data from Electric Capital's next report. If Solana's new developer growth keeps outpacing Ethereum's by a factor of 5 or more, the talent gap becomes a structural gap that is essentially impossible to reverse inside a single cycle. So here's the big question for everyone watching this video. Is Vitalik's smaller ship announcement the moment Ethereum stops pretending to chase Solana and reclaims its identity as the credibly neutral settlement layer that crypto genuinely needs as regulation tightens? Or is it the moment a foundation that has already lost its protocol leads, its narrative, and its biggest evangelists formally announces its retreat from the competitive arena while Solana, Hyperliquid, and a wave of specialized chains divide the spoils? Structurally bullish reset or structurally bearish surrender? Please let us know your thoughts in the comments below because we really want to hear your opinions on this. And if you want to understand exactly how Solana built the developer momentum that is currently eating Ethereum's lunch, then definitely check out our deep dive right over here. Thank you all so much for watching, and I'll see you again very soon. This is DC signing off.